Hi guys, my name is Ujjwal, and this session is to talk about our new portfolios that we've launched on Smallcase. We are a SEBI registered firm. Let me just quickly take you through the firm and give you a small background about WealthCulture. So, we are a SEBI registered research analyst and we are completely independent in our research. The idea of starting this venture is to help retail investors in their investing journey. I've personally seen a lot of retail investors lose money because they sort of don't understand the cycles, they don't understand the business, they don't understand the quality of businesses that they are investing in, and they just fall trap to the different cycles, news items in the market that are essentially meant to sort of increase the influx or the exit of money. So a lot of money that goes into stocks is inspired by the news item that flashes on TV on a day-to-day basis, and retail investors fall trap to that, not essentially understanding the fundas of the business, how the company is making money, what sort of promoters or management does the company have. So they don't get into all of that nitty gritties and just invest basis news and whatever is being discussed on Twitter, social media, and all of these. So, and then there are business cycles. So, what we've seen is retail investors typically they get very active in the second part of the bull run. And what happens is that as a consequence of that, they get trapped into the market at very high prices, and then they sell when the market is almost corrected and their portfolios are either in negative again or at very small profits. And this process is repeated again and again with every bull run and then a subsequent correction. And retail investors always tend to lose money because they are the lesser smarter ones versus the FIIs and all the big money that is coming from uh, mutual funds and international markets and all of that, right? So with wealth culture, my personal intention is to help as many retail investors as possible. Retail investors looking to invest 1 lakh, 2 lakh, 3 lakh, 5 lakh, smaller amounts which would not be catered by any PMS or advisory firm. This is my quick background. I have done my engineering from NIT Surat and MBA from IIM Shillong. Post that, I worked for 7 years in investment banking, uh, across 2 to 3 firms. I was also working in Cognizant, and then uh, 4.5 years I was part of Edelweiss as an investment banker. Closed couple of deals, worked on mergers and acquisitions, trying to raise private equity for small as well as medium-sized firms. So, and a lot of listed firms as well. So I had the opportunity to interact with a lot of CEOs and CXOs at very close proximity and understand how they think about valuation, how they think about their own business decisions and how they want to scale the company and what they say and what really happens on ground. Our investment philosophy is pretty simple. We believe in an active approach to investing and not a passive approach. What I mean by that is we do not believe in buying a stock and then holding it for 20, 30 years. That could very well be the case with a very few handpicked stocks where you can make money. But invariably, what happens is that the situation changes, the environment changes, the industry changes, and so you need to be an active investor to be able to evaluate the situation of the portfolio companies that you are invested in, and then accordingly modify your portfolio to suit the changing macroeconomic as well as the micro environment as well. And hence, we believe that an active approach to investing is best uh, when it comes to money management, especially in equities. And this way, uh, data shows that you also make larger returns over a longer period of time. Now, the way our portfolio is structured is we follow the core plus satellite approach to investing. What it means is that we have a core portfolio, which means a collection of stocks which invariably we will not tinker with unless there is something fundamentally wrong in those companies, or the industry is changing, or the dynamics is changing that is not in favor of the company. But invariably we will not tinker with these companies. We'll only play around the satellites. And what are these satellite stocks? These are stocks where we take a tactical approach, and that tactical approach could very well vary from 1 month to 6 months, or it can even go to 2 to 3 years, right? So time horizon is something that is that we are very flexible with. Some of the satellite stocks could give us quick returns in a very short period of time because of a special situation, and then some could even take 2 years, 3 years when it is a cyclical bet. Some cycles, take 2 years, 3 years to evolve. So those can be slightly more longer investments. But basically, this is how we structure. So we have a core portfolio, and then we have a satellite portfolio. Satellite portfolio is where you will see a lot of rebalancing happening uh, going forward, right? And like mentioned here, these are tactical bets. These could be sector rotation opportunities. uh, for example, we just saw the real estate sector boom, right? So there was a sector rotation opportunity where, if let's say 1.5 years back you had bought into real estate companies, you would have made decent returns. And then there will come a point when the real estate sector will sort of, you know, cap, which means it reach its peak, and then it will start correcting. uh, and very recently the rate hike that RBI has done is in some way going to affect that. So uh, so we have to be able to analyze some of these sectors deeply, understand the repercussions of these macroeconomic factors on these sectors, whether it is real estate, whether it is commodities, whether it is oil, whether it is auto, right? So some of these bets we take based on the sector rotation or cyclicality of the business, wherein we invest when that particular sector is at the bottom or closer to the bottom, and then we exit when, in our opinion, it has reached its top, right? And we could be sometimes a little too early and sometimes a little too late as well, basis our assessment. But essentially, that's the composition of the portfolio that is going to be the case in both our portfolios that are currently live on Smallcase. Now, even as we go about making portfolios, there are some common themes, some common pillars, you can say, which is very fundamental and sort of hygiene factors for us when we are investing, right? The first is that risk reward should be aligned. So we will not get into any investment opportunity where the risk is high, but the reward or the potential return opportunity is less, right? So opportunities anyway, either the risk reward has to be high in that sense, so high risk, high reward, or low risk, high reward, right? These are the two opportunities we will get into, but we won't get into the third option, which is high risk and low reward, right? So risk reward always has to be aligned in every investment that we make, and that's that assessment. We spend a lot of time doing that assessment for every stock, basis the valuation, the growth potential, and all of that, right? So risk reward should be aligned for every investment opportunity that we add to our portfolio. The second is that we have to fundamentally like these businesses and how they make money, the management, whether there is a moat around the business or not, in our opinion, right? And whether what is the recurability of these revenues, how strong is the defense mechanism, as in how defensibility of the business model is something that we study very deeply to be able to take an assessment, to take a view of the business itself and whether we like it or not. Uh, the third point is promoters and management. Now, you would have heard from every other investment advisor, and that is true. Promoters and management are very important, non negotiable factors when we make our investment decisions. We will not back a guy who is very shrewd and who is harming retail investors at and benefiting himself. That sort of management we don't like. We don't want to invest in those companies, and invariably character is very difficult to change. So if a investor, if a management or a promoter has shown that characteristic before, then most likely he will repeat that again in the future also, because it's very difficult to change someone's character, uh, right? So that assessment of character is something that we have to do. We have to do it very diligently. And in cases where we find that the management is not that good enough in terms of their own honesty, we will refrain from investing in those businesses. Apart from that, the management has to be very capable and smart and good at capital allocation, right? These are some hygiene factors. They should also have very good understanding of the business cycles itself, right? So in a commodity business, for example, what happens is when you are going through a peak cycle, a lot of these businesses end up doing a lot of capex, which expands the capacity not just for the company but for the entire industry. And then when the down cycle comes, the utilization levels go down, and then suddenly you will see the profits and the revenues and all of them tanking, right? And very few managements have that ability to restrain themselves not to go overboard in terms of capex when the business cycle is going good, right? Very few managements have that capability. So we also assess that capability in terms of their own capital allocation, and beyond, the basic hygiene of whether they are shareholder friendly or not. The fourth is the valuation, right? And this is very, very important again. uh, the price that we are paying and the value that we are getting, not today but 2 years 3 years down in the future, that gap has to be significant for us to take a stake in the company, right? So it could be a very good business, but then the valuation could be very high, in which case we will not get into such businesses, because those businesses, the valuation is going to correct. So we will wait for opportunities to enter in good businesses at right opportunities at reasonable valuation. If we do not get that entry point, we will not invest. There is no hurry. We are not suffering any FOMO. We don't have any pressure to invest. We could always hold cash and just let good times come for us to invest again, right? So we are not in any pressure, unlike a mutual fund or some people who have to allocate a lot of capital compulsorily. The revenue growth is very paramount for us, and depending upon the kind of business and the value businesses which trade at cheap, we would want at least 10% revenue growth. Growth businesses which trade at high multiples should grow at least 25%. Basically, the growth has to justify the valuation, right? So if something is trading at very high, the forward discounted EPS has to justify the valuation has to be justified by the growth. uh, and so these are the basic metrics. Last, uh, the company should have some sort of positive trigger. No matter what the business is, whether it is as part of our core portfolio or the satellite basket, it has to have some sort of trigger. Either the industry has to support, either the some change in the industry in terms of dynamics of the industry, or there is a change in management, or there is a new product launch, or the company is looking to get into new business sectors. So there has to be some positive trigger for us to enter into the company. So these are the six hygiene factors, I would say. Uh, no matter what the company is, whether it is a core company or a satellite company, we will evaluate all of these six factors, and only when we are satisfied that all of these six factors are satisfied by the company, then only we add it to our portfolio, both for the core part of the portfolio as well as the satellite part of the portfolio. Now, what is our buying criteria for growth businesses? So, we like to invest in both growth and value, by the way, right? So, both of these opportunities excite us, as long as there is decent money to be made there. Now, how do we go about investing in growth businesses? Some of the selection process is that, like we discussed, the revenue growth has to be more than 25% expected for the next 3 to 5 years, right? So The valuation has to be justified by the expected revenue growth. In cases where it is not justified, we don't enter into those stocks. Most likely they will go through a correction phase, the stock will tank, and hence it's not of interest to us. We will buy it when it comes down, not when it is at the top, right? So revenue growth is very important, along with margin expansion. We cannot get into a phase where the revenue is growing but the margin is going down. So invariably, when the revenue grows, there is operating leverage, and then the margin also expands. So the margin also has to expand along with the revenue growth. Third is that the company has to be low on leverage, and most importantly, it does not depend on external capital to fund its future growth. So whatever 25-30% the company is looking to grow, there is no plan to raise external capital. It does not need external capital. All the cash flow from operations after deducting for the capex is able to help sustain the growth rate. So the company's growth has to be self-sustainable in that way. We don't want equity dilution to happen, the company to go out, raise external money, dilute existing investors. Most likely they will have high debt, in which case they would want to do this. But otherwise, companies that have a very sustainable growth rate, low leverage, high margins, in making enough cash flows, not much money occupied in terms of working capital, then you will find the company is making decent amount of money and be able to drive their future growth rate using that money, using the internal cash flows that the company is generating. Right, so that is the sort of business model that we typically like. We don't want companies to go out, raise capital every 2 years, 3 years, and then dilute the existing investors. And then there's a lot of uncertainty also at what price it will happen, whether it will be up round, down round. As an investor, you are worried, right? You bought something at a higher price, and then the company 2 years down the line comes out and raises equity at a lower price. Will obviously get diluted, and most likely the capital allocation in those situations is not optimum. And as a result of that, the company has to go out and raise external capital, right? So some of these things is something that we sort of track and very important when we are selecting companies. Fourth, again, very important, smart and ethical management. I discussed this. We will not compromise on this. Fifth is again reasonable valuation. So we will invest in growth businesses, but those growth businesses we will invest at reasonable values. So we follow something called as GARP, which is growth at reasonable price. And there is another form of investing called BAAP, which is buy at any price. So we don't like buy at any price. We always like growth at reasonable price. Sixth is some sort of competitive advantage or moat the business should have. Some of these things are very qualitative, and we don't really get a hang of these things unless the business is 10 years, 20 years old. But generally, we want to see some sort of competitive advantage, whether it is in terms of employees, whether it is in terms of management, in terms of the business model itself, whether there is some sort of government support. All of these factors, one way or the other, has to bring some sort of competitive advantage or moat to the business. And the seventh is that the company has to be generating decent amount of cash flows, have to have at least 15-20% plus ROCE, and that has to keep going up from here on. So in our assessment, the situation should improve. If it is at 10%, it should go to 15-20%. If it has 20%, we should go to 25-30%, because stock price is relative, right? So if you're already at 30%, then the stock is also reflecting that 30%. Now, if you go down to 25%, the stock price is going to go down. Although 25% is a very good return on capital employed, right? So it's all relative when it comes to stock market. So it has to improve from the time that we invest. That assessment we have to do. Cash flows have to start pouring in. If not already, ROCs have to go up, right? So that assessment we have to do when it comes to investing in growth businesses. Value businesses, this is also an area that we like to invest, but then there are value traps along the way. So we have to be very, very cautious whether we are getting into a value trap situation. And hence, this is again a very active approach to investing, where we are evaluating these companies on a quarter-on-quarter basis, right? So the revenue growth has to be at least 10% plus. These could be uh, companies operating in sectors that are not growing as fast, but from our point of view the growth has to be at least 10% plus. And there has to be a certain future catalyst or a trigger that is going to change within the company, which is going to lead to higher than average growth. It could be because of management change, it could be because of launch of new products, some change in the industry dynamics. For example, what we saw in the sugar industry, where ethanol changed the game for the entire sugar industry. Or there is a significant deleveraging as well. So there's some activity that happened because of which the company is now planning to deleverage, which means the interest cost will go up, which means the profitability will go up. In which case your PE ratio can jump up, right? So all of these triggers are positive triggers. These triggers could interest us to invest. We could then look at these opportunities and say, okay, this looks interesting. Why not then deep dive and evaluate and see if we can make decent amount of return here, right? The company are also in value companies also, they pay a lot of dividend. So the cash flow has to sustain, the dividend yields have to sustain, and these have to be available at really cheap valuation. So the margin of safety invariably is very high, and these are low risk, high return opportunities if your judgment is right about the positive triggers and if those things pan out the way you've thought, which is why a very active approach to investing in value businesses is important, because then you need to track those metrics quarter on quarter and see if those things are changing. Most likely, this will also be backed by the promoter increasing his stake in the business, or some renewed interest from a private equity fund, who is also investing alongside. So that gives us some confidence that the promoters also believe in the story, or there's an external private equity fund who is also believing in the story. So it just gives us a confidence that yeah, we are also thinking in the right direction. And then, like I said, we do not invest in these companies in one go. We invest in tranches. Every good quarter we invest. We invest as the stock price goes up and not when it goes down. And if what we've expected, what we've hoped out of the business, if that does not pan out, then we exit the business, right? So see, the portfolio will go through a rebalance because of these issues, right? That we sort of took an investment decision and then 2 quarters, 3 quarters down the line, it did not pan the way that we wanted. And so we exited those investments, which is when we'll come back to you and say, okay, fine, we are rebalancing this portfolio. We are exiting from this stock and, getting into this stock, or we're moving out and holding just cash, right? That could also be the situation. So that's the approach of investing in value businesses. Now, what do we avoid, right? And this is very important. For example, from our point of view, when we are evaluating opportunities, we always look for reasons to reject, right? So if if my analyst comes and says this is a very good company, I'll start finding loopholes in that investing opportunity, and I'll start digging holes there. What's the management? Is there a criminal track record? Then reject it, right? We don't have to get into the subsequent sections if you are convinced that the promoter and the management is not good enough, or if there is an issue where the business model itself is not generating free cash flows, there's a lot of burn, and the future growth is also something that is big question. In those cases, we start with rejecting. So our portfolios invariably are very good companies, because we've tried all ways to reject the company, and then if we are not successful in rejecting them is when we include them in our portfolio. So that's the hygiene factor. Apart from that, even within good businesses, we will not invest in companies that are at super high valuation. So 100p, 80p, 90p, sorry, we are not investing. We don't think this is the right time to invest. Maybe those businesses, when they come down to their below their 5-year average PE, at that point of time, we may think about taking some stake in the business. But no, even in good businesses at super high valuations, we will avoid. We'll also avoid value traps, value opportunities where there are no future catalysts. where the positive triggers also do not exist, we will not get into such value traps. We'll not invest cyclical businesses when they are trading at their all lifetime high valuation, or when those cyclical businesses are correcting also. Right? What happens is that some stock went up and then it start correcting. So we now think, अरे ये तो सस्ता हो गया तो चलो ले लेते हैं. But it's not like that, right? Those cyclical businesses, you never know, they are falling knives. So you never know how much they will correct. So we will avoid them altogether unless we believe that they've really bottomed out, and now it cannot go below that. So there's a reasonable amount of margin of safety. So unless we get that confidence, we will not invest in cyclical businesses. Fourth is good businesses, but then they are in sectors that are slowing down. A very good example that I can think of is Castrol. Castrol is a very good business, excellent business, produces a lot of cash flow, available at cheap valuation, but then it works in a sector that is degrowing. So my view on the sector itself is not that great, which is why I will stay away from these businesses. Even though the valuation is very good, even though the price is very good, even though the cash flows are very good, I will stay away from such sectors where the value migration happening out of those sectors, values migrating into some other sector. Right? Invariably, these are value traps in a way. Fifth, hygiene factor, companies with poor corporate governance, sorry, we will not invest, no matter how good the company, no matter what capex plans they have, we will not invest. Sixth, public sector enterprises, because they are driven by a lot of government interference in terms of capital allocation, in terms of dividend distribution, which is why we generally don't like public sector enterprises, and without exception, we will stay away from them. Now, let's talk about an exit strategy. How do we decide when to exit? Most likely, when we find a better opportunity, right? So, companies which are where the risk reward situation is very favorable, we will move some money into those opportunities, or where the story no longer holds true, which means that we thought of something and then it didn't happen, which could be a value trap, and so we decided to exit. So that could also be the situation for us to exit the stock. The third is when some of these stocks get very extremely overvalued, we know that it has become so expensive that over the next 2 to 3 years, only a correction can happen in the stock, right? This stock now cannot go from X to 2X. It will only get from X to 0.75X over the next 2 years and then start going again. So next 2 years, there is not much opportunity in this stock, very overvalued. So we will exit, and then we will evaluate at a later date when the stock is again within our investment horizon. Fourth is when the investment itself has panned out. So the satellite approach that we take, or the tactical approach that we took, whatever returns that we plan to make, we've made those returns. So in those situations, we will exit those opportunities and move the money to newer investments or just hold cash. So that is typically how we look at our exit strategies. Now, let's quickly talk about our small case portfolios. We are launching, or we've already launched 2 portfolios. One is called Small and Mid Cap Underdogs, and the second one is called Large Cap Titans. As you can see here, over the last 1 month, the stock market has seen immense correction. Our portfolio is also down by almost 10%. The minimum investment is about 26,000 or so. Now, the way I think about it is that when the market revives, we could see a quick 10% return from here on, which is why my suggestion to investors is that you should not be afraid of this negative number. In fact, don't be very happy when you see a large number here, because that large number is history. It is not what you make in the future. What you make in the future is a very different story from what is written here. So take a wise decision. The markets have corrected, which is why this number is red. So you have to invest when the markets are at low, right? Always take opportunity, take benefit of that opportunity, that if there's a certain correction, then you invest. Fundamentally, these are very good companies. In the small and mid cap underdogs, we are investing in companies which are less than 20,000 crores in market cap. The drawdown can be significant, as you can see here, So you have to have high risk bearing capacity, which means you have to be able to bear with some sort of drawdown, not panic when you are seeing your portfolio in red. And investors who can bear with that, they will also make higher returns over the long term. So this portfolio is best for investors who can handle volatility, not panic, and they also want to expect large returns over the long term. So this portfolio is suggested to that sort of investing investors who are typically fine with high risk, high reward or sort of situations. The large cap Titans portfolio, as you can see, 1 month returns only 1.94% fall, although the market has seen a lot of correction. So this is a fairly stable portfolio, blue chip stocks. You will not see much correction here. Your capital protection is guaranteed, although nothing is guaranteed, but the focus here is capital protection. And this is ideal for investors who are not so much risky. So the risk appetite of these investors is very less, which is the minimum investment amount is about 43,285. That's slightly higher because these are blue chip stocks. Some of these stocks are expensive. And the strategy here is to make, first of all, the strategy is to protect the capital. And then on top of that, we do capital gains and then we also do dividends, right? So you should look at returns by combining capital gains and dividends together, because we've also sort of invested in companies which will pay you good amount of dividends as we go ahead in the future. And you could also expect some sort of capital gains as well. So the capital gains plus the dividends should give you decent amount of returns. Now let's look slightly deeper into the small and the mid cap underdogs portfolio. As you can see, this is purely small cap dominated. There are 10 to 15 stocks in this portfolio, and this portfolio will be rebalanced once every quarter or on need basis, right? So we are very flexible with the rebalance. As you can see, this is all dominated by small caps, and this is diversified across sectors. So we invested in three-wheelers, consumer finance, banks. We also invested in beverage companies, footwear, outsourced IT companies, technology companies, home electronics. So the diversification is fairly good across all the sectors. The annual subscription fees of this portfolio is less than 3,000 rupees post by using the coupon code, which is WC20, WealthCulture20. WC20 is the code. You can use that code to get a 20% discount on the portfolio. And what I am suggesting is that you should increase the investment amount to at least 1 lakh over a year, because your fees should not be more than 3%, right? So typically 2.5% is the max that you should go, which is why, if you are starting with 26,000, please increase the invest amount to 1 lakh so that the fees is justified. We've kept, and with that, even investors who are looking to invest 1 lakh plus can invest with us. We want to really help retail investors, handhold them. We want them to make money in the stock markets, and that is our intention here. Large cap titans, this is the second portfolio. As you saw, the drawdown is very less, very stable portfolios. Again, 10 to 15 stocks in this portfolio, mostly dominated by large and mid cap stocks. So 20,000 crores market cap, that is the condition we have, and diversified across sectors. So again, auto, insurance, software, plastics, fertilizers, FMCG, private banks, we are across sectors. And the subscription fees, again, in this case is also less than 3,000 annually. You have to use the code WC20, like I mentioned. And here again, I would request that you increase the investment amount to 1 lakh plus, so that the fees is justified, right? You're not paying more than 2.5-3% on this portfolio. Now, I also want to give some flavor of the kind of stocks that we have in the portfolio. As you can see, small and mid cap underdogs, we have Atul, Talbros, Vaibhav Global, many more interesting opportunities. All of these opportunities we believe are multi-baggers, right? So are depending upon the investment horizon, which in our case is anywhere from 3 to 5 years. And we'd request you that you please be subscribed for 3 to 5 years to actually benefit from these. We are hoping these portfolios to give returns from anywhere from 3x to 5x over the 3 to 5 year period, right? And we should see some sort of outperformance to start from the quarter of FY23, because most of these companies are beaten down by COVID, available at very cheap prices, but these are good brands run by good management, and they have a revival plan in place. They have, in fact, some of these companies have increased their capacity during this period, and they are much more resilient businesses after the COVID situation. So we definitely expect these businesses to bounce back and give us very good returns over the next 3 to 5 years. We use all sort of strategies here. We invested in all kind of companies here. We've invested in growth stocks. We've invested in value stocks, which are available at very cheap valuation today, right? And then there are sector rotation plays as well. The same thing is applicable for large cap titans as well. Here, these are very stable, consistent performers uh, that will give you capital appreciation. Plus, they will also give you a decent amount of returns. And then there are situations like HDFC Life, which got beaten down excessively because of COVID. It was a short-term phenomena where there was excessive claims, and then the profitability went down, which is why the stock also tanked. But then, I know, penetration of life insurance products is very small in India now. It's a multi-decade, long-term theme that you should invest. In fact, this one would actually go into your core portfolio in a sense, right? So that's how we've cherry picked stocks, basis the current valuations, basis the future opportunity. We've stayed, we are sort of taking advantage of the sector rotation opportunity by currently investing in auto and banking sector and not investing in IT companies. So all of these large cap IT companies are at very excess valuation. We believe there is correction due for at least 1 year in all of these stocks, and hence we are not including any IT stock in this portfolio. We've included auto, we've included banking. Both of these we believe have bottomed out, and going forward there is potential for these stocks to do well. In fact, the Q4 for March 22 year was actually very good for all of the banking stocks. These are again blue chip companies. You don't have to worry about the quality. Most of these stocks will give you some sort of capital gain, and they will also give you dividends, right? So when you look at the portfolio, look at the cumulative returns, including the dividends as well. So that's the quick overview of the portfolios and what we're doing at WealthCulture and what we're launching in Smallcase. We are available. My email ID and Twitter handle is mentioned here. You can always reach out to us. Our Smallcase website is wealthculture.smallcase.com. Do check out our portfolios, and if you want to invest, you can use the code WC20 WealthCulture20 to get a 20% discount on both the portfolios over the annual subscription, not the 6 month subscription. And then do check out our YouTube videos. We make detailed videos across different industries for retail investors for you to understand these businesses and then have that conviction to stay invested for the long term, right? That is where we believe you will really make money and not get driven by the daily news that just fills your mind and forces you to take the wrong decisions. So please don't invest without doing fundamental research. Have that conviction, stay invested for the long term, and you will definitely benefit from this beautiful thing called investing. It has great potential to create wealth for you and to make your money work for you, uh, so that you don't have to work all your life. Thank you and have a great investing journey. Best wishes.